Try this. All right. So, are you a busy professional or a working executive? You may not have that time to check his or her stock portfolio every now and then because of the clashes, and you don't want to give up your work hours checking stock because you know that definitely that would affect your maybe performance review or whatever. Now, I want to tell you the two must-have portfolio that we cover up for that particular setback. Yes, these two must-have portfolio are strategic portfolio that would keep you, that will continue to grow your funds in the stock market far beyond inflation and far beyond treasury bill, commercial paper, or any fixed income instrument. These are portfolios that have historically tested, and I'm going to show proof as we proceed. So these are two must-have portfolio for you. You don't have to monitor them every week. Maybe you can even check maybe once in a month, but make sure you consistently build that portfolio by adding funds to that account, maybe at the end of the month, so that when new opportunity shows up, you'll be able to key into such opportunity. And those opportunities don't show up every week or every day. It comes based on market events. So once that market presents opportunity, sorry, you'll be able to jump on that stocks and buy immediately. So before we continue, my disclaimer as usual, please, the ideas shared in this video are based on my personal research and calculations. Kindly do your due diligence before you invest in this company's stock or whatever strategy I'm going to share. And also know that the stock market comes with a lot of risk due to uncertainties. And also make sure that you vet my recommendations based on your risk profile. So let's quickly look at this. As a busy professional or an executive or a business owner who is not ready to share his or her productive hours to avoid losing your current streams of income, but still want to leverage opportunities in the stock market, this is for you. So if you're a business professional and you can't risk that, you can't risk sharing your productive hours with that of stock market because you know there's this particular stuff that is at stake, and that's your salary or whatever pay you get at the end of the month. I usually say this that the stock market is not for the unemployed. The stock market is actually for people that have streams of cash flow because it is your stream of cash flow that will help you exercise patience. An unemployed person does not have any business investing in the stock market because when there is time for you to sort an expenses, what do? You go to your stock and then you eventually take out money from your stock immaturely. But yes, that's early enough. Unlike someone who is working, who is able to fall back to his or her savings and then take some money there while allowing his investment to grow over time. So the stock market is not for the unemployed. It's for people that have stream of income, either from your business or from your salary or whatever you do. So let's continue. Now, in this video, I want to talk about two must-have stock portfolio that will pump more money into your bank account year on year. There are two portfolio you must have. And this portfolio will historically grow your portfolio, will grow your cash over time, far beyond treasury bill. Yeah, some of us are used to putting money in treasury bill, which is not bad. Diversify, have an income portfolio. But here, this particular portfolio over time will grow far more than treasury bill, government bond, commercial paper, or fixed deposit. Watch out. These are two must-have portfolio. They are strategic. Yeah, some of us might say, oh, it's not just have a trading account or an investment account. Remember, if you are a busy professional, these two must have accounts. They are strategic. The first one is your dividend growth stock account. So when you open a brokerage account, target a dividend growth stock account. I did not say a dividend account. I said dividend growth stock account. This account would help you take advantage of two things: cash dividends and capital appreciation on a stock. Dividend growth stock and dividend stock are not the same. So some of you are used to dividend stock and they say, oh, I want to buy a stock for dividend. One thing I've come to understand is that most dividend stocks in the market, they are nothing, they're not even anything close to your fixed deposit. It would have been better to invest in fixed deposit or treasury bill than to put your money in dividend stock. If you buy only dividend stock, yes, they will pay you cash dividend, but I can tell you, you are actually shortchanging yourself. You're not maximizing return from the stock market. upgrade your choice to dividend growth stock. And I'll tell you why. Now, dividend stocks pay cash dividend, right? It is the growth nature of that. You see this growth. It is this growth that will give you more capital appreciation over time. So that's why I call it a stock that will help you eat your cake and have it. Historically, I have seen my dividend growth stocks portfolio deliver between 50 to 100% annually, year on year annual return, sorry, year on year in the last 3 to 4 years. I earn cash dividend of at least 10 to 14% per annum. So that means when I receive my cash, I earn between 10 to 14% on that portfolio per annum and still liquidate my portfolio for double-digit gains, almost 4 to 5 times inflation rate in Nigeria. Let's break it down. Now, what are dividend growth stock? These are stocks you buy for cash dividend. And that growth nature in that stock is because they are benefiting from macro events. So meaning that there's tendency for price to appreciate. Why does price appreciate? Because investors are seeing the potential of that company not only paying dividend, but also grow over time. And the company is benefiting from. So this growth nature is the macro trend that is supporting improved financials. That's why we call it dividend growth stock. I usually post dividend growth stocks every year, and I'm very strategic. I don't post dividend growth stock every month. I have a period in the year that I recommend dividend growth stock. These are dividend growth stocks I posted in 2025, around May, June, July. Now, you can see UCAP, UBA, Stanbic IBTC, and Zenith Bank. I call them dividend growth stock. Why? Because in terms of dividends, they offer yield above 10%. So the average yield on these stocks is actually above 10% based on what I'm expecting them to pay out. And now their share price, from the time I recommended them to now, look at what they have done so far. I can even update it. Now 40, 24, 54, and 63. So averagely, these stocks have done 40% in just 4 or 5 months. And I am holding them into next year. So the plan is they will not only pay me dividends, but as well as deliver massive capital appreciation. This kind of stock, you don't have to trade them every week. Just buy them the period I recommend them, leave them and go to whatever you want to do. You don't have to look at whatever price is. Because the fact that their prices are attractive at the moment, the fact that they have good fundamentals supporting being supported by macro trend, meaning that by the time they release their full year results, profit will be high so they can declare more dividend. A lot of investors will start jumping on them. This is what I call dividend growth stock. That means they have the feature of a dividend stock, which is cash dividend, and then they also have the feature of a growth stock, which is capital appreciation. So you need to upgrade your thinking from just buying dividend stock to dividend growth stock. Some of my big dividend growth stock winner, custodian investments, AXA Mansard, Stanbic IBTC, GTCO, Zenith Bank, UBA. Some dividend growth stocks can come up every year. So how exactly do I invest in dividend growth stocks? There's a particular period that I do this. It runs for like 3 months. Now, that period is always strategic for me. I've shared that in the community multiple times. Now, within that period, a lot of stocks have been marked down. Within that period, a lot of good stocks have suffered. A lot of good stocks are down, maybe because they just finished paying dividends or they've been marked down and then people have sold them thinking that they will come back next year. So you are taking advantage of that opportunity based on multiple factors. On Glofolio, I've shared dividend growth stocks multiple times. And most of my dividend growth stocks, they have delivered good returns. Like here, I talked about dividend growth stocks in May, between May, June. So let's see if we can find that particular write-up. Yes, look at it here. In May 2025, 4 stable high-yielding dividend growth stocks to buy. This is for 2025 peak. So let's go back to 2024. You will see the one I recommended in 2024 too. So dividend growth stocks are portfolio you must have as a busy professional because you don't have to trade them every now and then. You hold them to collect dividend in next 1 year. And while you are waiting for them to pay dividend, naturally their prices are appreciating. The reason is because they are considered attractive within that period in terms of dividend yield. And four, they are benefiting from macroeconomic events. It is that macroeconomic event that will drive capital appreciation. So you need to pay attention to this type of stocks. They provide good. I'm trying to locate the dividend growth stocks that I dropped in 2024 on the platform just to explain what I said earlier on. So let's see if we can find that recommendations here. Dividend growth stocks. It says cash rich stocks to own. Let's see. Yeah. I'm just trying to look for that right up here. Turnaround stocks. In 2024, I'm looking for that. One high yielding dividend growth stocks in 2023. Um, Trying to look for that. I guess the article is probably uh back before most of this post. So I posted stocks like Custodian, AXA Mansard, yes, in 2024. So let's go back to that Custodian, AXA Mansard. So in 2024, for those that joined Global community, yes, I posted Custodian in 2024 around that May period. Yes, within this period. Yeah. This period, custodian was recommended, some answer was recommended. The reason these companies were benefiting from macro events. And what was that macro event? Exchange rates. Custodian, Axel Mansard, GTCO. So when you are investing in the market, and then you feel that you don't have time, you're busy, build a dividend growth stock portfolio. You only buy them between May to July, then you leave them till the following year. It's as simple as that. My dividend growth stocks, I don't touch them. I don't touch them. What am I? Because one, I'm looking at capital appreciation as well as dividends from them. Now, it is the juicy dividend available on those stocks that will make me to jump on them. Now, this doesn't mean these stocks are buy. No, I'm only give you an example of stocks I've traded as dividend growth stocks in the past 3 to 4 years. So when you are investing in the market as a busy professional, first portfolio is your dividend growth stock portfolio. Remember, you're buying stocks that you don't have to touch. Why dividend growth stocks? Why should I build a dividend growth stock portfolio? Remember, dividend growth stocks and dividend stocks are not the same. So because a company is paying dividend does not automatically qualify it as dividend growth stock. No, there's a lot that makes up that growth nature. Why dividend growth stocks? These types of stocks usually attract institutional money. Can you see? So it is not every dividend growth stock that attracts institutional money. Because a company paid dividend does not mean that insurance are buying it. No. Dividend growth stocks usually attract institutional money first. So during market dip, during market sell-off, like right now, you see a lot of pullbacks in the Nigerian stock market. I'm excited because if the pullbacks become intense, it means that some stocks are going to give us. Normally, my dividend growth stocks are always between May to June, July. But if the market goes down significantly in such a way that some stocks are not giving us dividend yield above maybe like 10%, 11%, and they are benefiting from macro trends, then it means we'll most likely be having access to new dividend growth stocks this month, September, maybe from 1st of September to the end of this month. So that's why sometimes when I see market dip, I'm always excited because it gives me an opportunity to key into what I call the dividend growth stock. And when market dips, they are usually the first to recover. Whenever there's a tank, whenever the stock market goes down, the first set of stock to recover faster, to tell you that the market is about to go up, are always dividend growth stock. Why? Because at that bottom, yield is attractive. You see some stocks offering yield of 11%, 12%, 13%. And then when you add that to the capital appreciation that will come over time, then you're going to be making a lot of money. So 10, 11, 12% has already taken a size of your return, giving you a guaranteed return. Then the other 30% can come for capital appreciation, which could be more. So during market dips, they are usually the first to pick up. And it's also because they have attractive dividends. So dividend growth stocks usually have attractive dividend plus growth catalyst. So imagine buying a stock that the yield is around 13%. For example, UBA. yield on UBA is around 12-13%. And the growth catalyst behind UBA is elevated interest rates driving the corporate earnings. Because one thing I noticed on UBA's financial is that UBA is leveraging the money market, which is treasury bill, as well as corporate loan, high interest on corporate loan to drive its interest income. So these are growth catalysts that I noticed. So that plus dividend yield makes UBA a dividend growth stock in the market. So the growth catalysts could be events, maybe policies, government policies, or trends that will support improve financials and drive cash flow that will make the company declare higher payout to shareholders. So dividend growth stock are strategic stocks in the market. Everybody is talking about dividend stocks in Nigerian stock market. Nobody is talking about dividend growth stock. And dividend growth stock will give you more money than dividend stock. These are history. This is it here. So if you want to build a portfolio of stock that would pay you without having to check your portfolio every time, this is the first portfolio you need to build. Dividend growth stock. Very, very important. Dividend growth stock. So the best time to buy dividend growth stock is between May to July 2025. That's the best time. I bought my dividend growth stock. So if I'm looking forward to building another dividend growth stock portfolio, then I should be looking forward to next year, May to July 2026. So the idea is I buy them now, I buy them in May, June, July 2025, hold them into maybe like April, May next year. By April, May next year, that's why I'll be collecting dividends. I'm collecting dividends from the stocks. I'm selling. That's how I'll liquidate the portfolio. When I liquidate the portfolio, the next thing I do is to wait for another dividend growth stock within that period because more stocks are going to show up. Now, it's also possible that some of the stocks you bought the previous year can also qualify for dividend growth stocks as dividend growth stocks the following year. Do you understand? It's possible. Example is Mansard. Mansard was dividend growth stock in 2023. Mansard was also dividend growth stock in 2024. Let's look at AXA Mansard to explain that. So you can have a stock double as dividend growth stock twice in 2 years. So it's not compulsory that you must pick new stock every now and then. No. Most important thing is for that stocks to still be within range. Make sure the stock still meets all the criteria that makes it a dividend growth stocks. I usually share this strategy in our ETC class. So here is AXA Mansard. You can see AXA Mansard in 2024. Let me expand my time frame to weekly. Yes. So in 2023, AXA Mansard was a dividend growth stock within this period. Here, you can see here, AXA Mansard was a dividend growth stock between April, May 2023. Now, again, in 2024, AXA Mansard was also a dividend growth stock here. You can see here, was also a dividend growth stock. So a stock can be qualified as dividend growth stock in first year, second year, as long as you meet the criteria. That's the most important thing. Do you understand? So meaning you can own the same dividend growth stock year one, year two, year three, as long as when it's time for you to reshuffle, it still meets your criteria. So you collect your dividends, reinvest, build a fresh portfolio, run again for the next year, do the same thing. So as you are reshuffling every year, you are growing your return by compound. You are growing your return, you are compounding your return. These are return that will most likely, in short, will outperform so far. When did I recommend this stock and what's the average performance right now? You will see here. Yes, although I'm yet to update the sheet, but that gives you a rough estimate. Some of people are waiting for 16% in a year on TB when dividend growth stock have already given me far more than that in just 3 to 4 months. So when you are buying dividend growth stock in the market, just know that you are buying stocks that you don't have to touch at least for like 10 to 12 months because you're waiting to collect cash dividend as well as allow macro event to drive the stock. You can see what AXA Mansard did. AXA Mansard between April, May 2023, it did over 100%. And then in 2024, AXA Mansard did over 100% too. So, but in 2025, AXA Mansard was not part of dividend growth stock in 2025. Yes, even though we saw a market rally driven by policies in the insurance sector, but it didn't qualify as an insurance dividend growth stock. Custodian, like I said, did give us the same opportunity. Custodian was a good dividend growth stocks in the market, but for capital appreciation, Stanbic IBTC gave us the same thing. So knowing the best stock to buy within that May to July would help you position your portfolio for not just for cash dividend, as well as earn good capital appreciation in the market. So the first portfolio is your dividend growth stock. First portfolio is your dividend growth stock. Remember, these are portfolio that you don't have to monitor. These are portfolio that you are only going to buy stock and let them run for 10 to 12 months, and then collect your cash dividend as well as reap from capital appreciation. Now, just know that those sell in May and buy in October is a useless concept for profitable dividend investor. So all those people that always shout sell in May and buy in October, it's a nonsense concept. That sell in May, if you adopt a contrarian approach, you would have built solid dividend growth stock, offering yield, attractive yield above 10, 11%. And then by the time you compare their future payouts, there are a lot of conditions to buying dividend growth stock. You don't buy dividend growth stock because they pay dividend. So many things are put in place. That's why if you look at my dividend growth stock, you can see that they're just 1, 2, 3, 4 in the market. So you would have asked me, why didn't you buy XYZ? I thought they pay dividend. There is a lot I watch out for before I tag them dividend growth stocks. Now, it doesn't mean they are the best stock in the market within that period, but most likely, in terms of the checks I use to add stocks to my dividend growth to my portfolio, these are stocks that pass that particular check within that period. So, and I like to keep my dividend stock limited, 3 or 4, because in the stock market, less is more. You don't buy a lot of stocks to dilute your earnings or slow down your earnings. If you have 3 or 4 stocks and you go big on these stocks, at least your return from cash dividend will be significant, as well as capital appreciation. So if you're a busy professional, dividend growth stock is a must for you in the market. It is not just dividend. Please note it. Don't say, oh, I said dividend growth stock, then you start buying any dividend stock. It has to be dividend growth stock in the market. If I have dividend growth stocks in the market right now, I will definitely share it with members of my community. That's why I'm excited that the market is actually pulling back. Because when the market pulls back significantly like this, then we most likely be getting access to new dividend growth stock in the market. But most of the time, my dividend growth stock always comes between May to July. But if we see any right now as the market is tanking, definitely why not? We'll jump on them and then recommend in the community. The second set of stock, you don't have to check. You don't have to check. Just buy them and hold them over a year are the G30 stocks. The G30 stocks. These are the two must-have portfolio for you as a busy investor. What are G30 stocks? I have a video on my platform that explains G30 stocks. Now, G30 is an in-house index for us. Now, these are steady return picks I personally discover from a pool of NGS 30. I'm sure you know what NGS 30 is. Top 30 most capitalized companies in the Nigerian stock market. Now, I picked my G30, which is Global 30, from this particular pool of 30. That means if I look at all the top 30 stocks, I look for what I call the fundamentally sound oversold stocks. G30 are liquid stocks and as such command institutional attention. So if you look at the dividend growth stocks and the G30 stocks, you find one thing in common. They are always attracting institutional attention. Liquidity is very key. You're buying stocks that are liquid. You're buying stock that institutions are buying. One thing I love about these stocks is that they don't experience massive volatility because they are controlled by institutions. And institutions don't buy and sell every day. Before they even enter a stock, they have to go through certain checks. They have to policy meetings, boardroom approval, and then it takes time. And then even before they sell a stock, the same thing too, they have to go through. So insurance don't enter and exit randomly. That's why you see this kind of stocks experience some kind of stability in the market. Now, it doesn't mean the price don't go up or down, but you see that swing. That swing is limited. So they don't experience unusual volatility every time. And G30 stocks are fundamentally sound oversold stocks, prime for capital appreciation in 6 to 12 months. So if you ask me what are G30 stocks, they are fundamentally sound oversold stock that are prime for capital appreciation in 6 to 12 months. So I will look at the NGS 30 stocks and then look for G30 stocks in that index. These are stocks I buy. And when I buy them, I hold them at least 6 months, 12 months. You don't have to trade them every now and then. That's G30 stocks for you. So for instance, now this G30 stocks is down in 10 months. So something like this, I buy them, I hold. This is also another one in the market. I buy them and I hold. So G30 stocks are not stocks you trade regularly. And then we also have a G30 tracker. Our G30 tracker has also been good so far. In short, let's even start from 2024. Now, these are my G30 in 2024. Yeah, I started tracking the G30 index in, I think, from June, July 2024. So these are my G30 stock in 2024. And then these are the performance between June, July to December. So you can see right here, we started tracking between July to December. Yes, this is the performance between July to December. So, and then this is what the NGS delivered from January to December. So, in July to December, our G30 stocks did 38.9%. Why? From January to December, the overall market delivered 37%. This is it here. That's from January to December. So, you can see that even in the short month, we're still able to outperform the overall market. And then the G30 stocks for 2025 is also doing well. We are also outperforming the market. We'll be having our September webinar in probably in 2 weeks. Yeah, in 1 week or 2 weeks or so, but I will definitely drop the announcement. And then average performance of our G30 is 67. And yes, the NGS index has dropped. So definitely our estimated ROI should also drop, but we will still be ahead of the market. So from January to date, this is what we have done. And then the market itself, January to date, this is what it has outperformed. So you can see that we are still outperforming the overall market based on our G30 picks. Now, do you have to trade them every now and then? No. All you need to do is to buy them when they are recommended and hold them over a 10-month or 12-month period in the market. They are stocks that are loved by institutional investors. And as such, they don't experience massive volatility like you see them. Because for this company to move them to the upside or move them to the downside, they have to take, it takes time to take decision. That's one thing I like about following institutional investors. When they decide on buying a stock, they must have done their checks, due diligence, and when they enter the stock, they tend to hold that stock for a longer period of time. So when you're buying a stock that institutional investors are buying, you see that volatility is low because they are the one moving the market. But when they are moving the market, they move the markets hard, either to the upside or downside. So you must also have a portfolio of G30 stocks. Now, G30 stocks doesn't necessarily mean that they must be high dividend stocks. No, some of them may not pay dividend, but because they have that nature of growth in them, because they are heavyweight, they are NGS 30, dividend may not be too attractive. Yes, they may pay you dividend, but you're not buying them because they pay you dividend. You are buying them because they are fundamentally sound oversold stocks, prime for capital appreciation in 6 to 12 months. So if you hold dividend growth stocks portfolio, and G30 stock portfolio in the market, you would still outperform the market. Especially when you buy these stocks the time I share them in the community. So G30 traders enjoy volume advantage because they move with the market, they move with investors. So buying and selling these stocks are not, that's why I talk about liquidity in the stock market as being a major selling point. You can go into the market with a volume with huge money, amount of money, actually you know what you're doing, and you exit and nobody knows. That's the advantage the stock market enjoys over real estate markets. Because in the stock market, you can liquidate a portfolio today and you get your cash in 3 days, T plus 3 settlement. But real estate, at least you give yourself a minimum of 30 days before you can liquidate an asset or a property. So G30 trader enjoy volume advantage. Buy after market sell-off before the, so G30 traders, we usually buy after market sell-off. So now that the market is going through sell-off now, that's where I am excited. So for us in the Follow community, we are excited because we usually buy after market sell-off. So if the market goes through a sell-off, what are we doing? We are looking to take advantage of opportunities on dip. So in G30, we usually buy after market sell-off. This market sell-off we enter. This market sell-off we enter. So now if the market is going through sell-off, tells us that new opportunities are going to show up very soon. But if the market continues to rally higher, how do we find new opportunities to trade? So if you are a contrarian traders in the market, that means you buy when everybody is selling. This is the period for you to get your cash ready because very soon a lot of stocks are going to give you are going to be attractive, especially the fundamentally sound oversold stock. G30 have historically beaten the market index. I've showed you at least the one we track in 2024 and 2025. Now, it doesn't mean that all the stocks in NGS 30 are G30. What makes them G30? Let me recap that. What makes them G30 is the moment they become oversold, the moment they become fundamentally sound oversold. So if they are not oversold, if they don't have good fundamentals, they are not G30. So they can be NGS 30, but they may not be G30. So what qualifies them as G30 is the moment they become oversold in the market. So what are the NGS 30 stocks components in the market? So you have them here. These are the stocks here. You have the likes of Airtel, Bway Food, MTN, Dangote Cement, Bway Cement, GT Co, Seplat, Geregu, Zenith Bank, Aradel, Nigerian Brewery, Transcorp Power, International Brewery, WAPCO, UBA, Transcorp Hotel, Stanbic, Nestle, Presco, Access, First Bank, that's First Co, Fidelity, Okomu, Owando, Dangote Sugar, Eco Bank, Wema Bank, Transcorp Transnational Corporation, FCMB, and UCAP. So it is from this particular list that I pick the G30 stocks. Now, you see that these are well-known stocks. These are liquid stocks. These are stocks that institutions buy. So when institutions, maybe like asset managers or insurance companies wants to diversify into stock, maybe it's just a bit of whatever they have collected from as premium, or maybe mutual funds, equity mutual funds, or foreign portfolio investors, when they want to buy, these are the kind of stocks they want to jump on because they have tendency of providing liquidity. You can easily enter and exit. They are known brands and they're also known for stability in the market. They don't experience swings like that, like massive swing. So this, and in terms of liquidity, like I said, you can easily go in and out without being worried. So it is from that list that I pick the G30 stocks. So you can also have your second portfolio as G30 so that you can take care of such kind of stocks and opportunity in the market. Like I said, G30 traders don't trade every day or week. You don't have to sit in front of your system looking for new opportunities. No, you buy them, you hold them over a 10 or 11-month period, even 12 months, and then before you consider selling. So that also gives you that flexibility to work without having to or without being worried on whether you are losing opportunities in the stock market or not. And again, G30 stocks are best for busy professionals or executives. So if you're a busy professional, you're a busy executive, jump on G30 stocks. It will give you, provide some level of confidence in the market. So even if you're working, even though you remember that you have some portfolio in the market, you will see some level of assurance because you know you have not only bought stocks randomly, you have bought fundamentally sound oversold. So that means majority of the stocks you bought, you enter right at the bottom of the market. The reason why this portfolio is green is because we entered right before the move. I've talked about most of the stocks you have here, so I don't want to be stressing them again. But the idea is to understand the criteria behind the entry. So these are G30 stocks that will enter right at the bottom of the market. And then the second one is the first one is what? The dividend growth stock. So if you hold a dividend growth stock portfolio and then you have a G30 stock portfolio, I bet you will not be worried again in the market. You will not be worried checking stocks every now and then because you have built strategic portfolio that historically have outperformed the market and will continue to outperform the market over time. And the good thing about this set of portfolio is that they attract institutional interest, institutional investors in the market. If this video makes sense to you, kindly hit the subscription button and turn on the notification bell so that when I release more videos like this, you'll be among the first to get notified. And if you're here to join our community, kindly go to www.follow.com/subscribe. We'll be having our September webinar very soon. I'll be sharing the announcement and I'm not sure you want to miss it. So you can probably learn insights to take advantage of market dip at this particular period.